I need to share something with you that just came out from one of the biggest investment banks on Wall Street. JPMorgan has released their technical strategy report dated February 5th, and what they are saying about gold, silver, and copper could completely change how you approach the metals market over the next several months. Before I get into the details, let me tell you exactly what the headline is. JPMorgan is calling for a consolidation phase across all major metals. Gold, silver, copper, they are all expected to enter a period of sideways price action in the coming weeks. But here's the critical part that most people will miss when they see that headline. This is not the end of the bull market. According to JPMorgan's own analysts, this is what they call a necessary respite within a long-term upward trend. In other words, the music has not stopped. The band is just taking a break. Now, I want to hear from you before we go any further, what JPMorgan is saying and why it matters for your portfolio. The report comes from Jason Hunter, who is an analyst on JPMorgan's global market strategy team. He is their technical strategist, which means he focuses on chart patterns, price levels, momentum indicators, and the technical structure of markets rather than pure fundamental analysis. This is important context because technical analysis tells you about market psychology, positioning, and potential price targets based on historical patterns. According to Hunter, the recent movement in gold prices represents a typical short-term reversal after a sharp rise rather than the concluding phase of a long-term uptrend. Let me read you exactly what he wrote. Quote, "We believe the recent movement in gold prices represents a typical short-term reversal after a sharp rise rather than the concluding phase of a long-term uptrend." End quote. This is a crucial distinction. A short-term reversal means the trend is pausing. A concluding phase would mean the trend is ending. JPMorgan is explicitly saying they do not believe the gold bull market is over. They believe it is taking a breather. Technical charts show that after experiencing what Hunter calls a parabolic rise, the momentum of gold prices has shown obvious signs of exhaustion. What does parabolic mean in trading terms? It means prices went up at an accelerating rate, almost vertically on the chart. When any asset goes parabolic, it becomes unsustainable. The rubber band stretches too far and it has to snap back or at least consolidate before the next move. JPMorgan predicts that in the coming weeks or even months, the gold price will form a wide-ranging holding pattern characterized by significant fluctuations. This means we should expect chop. We should expect volatility within a range. We should not expect a clean directional move either higher or lower in the immediate term. Now here are the specific levels that JPMorgan says matter most. On the upside, the $5,000 mark represents substantial resistance. Beyond that, the $5,100 to $5,150 range poses an even more significant ceiling. These levels are expected to limit the short-term rebound potential of gold prices. In plain English, if gold rallies, it is likely to struggle around $5,000 and face serious resistance between $5,100 and $5,150. On the downside, JPMorgan says investors should first watch $4,500, which corresponds to the 50-day moving average. But the more crucial buying range, according to their analysis, is between $4,264 and $4,381. This was the breakout zone from the fourth quarter of 2025, and they expect it to provide stronger support. Let me repeat those levels because they matter. Resistance at 5,000, strong resistance at 5,100 to 5,150, initial support at 4,500, strong support and buying zone at 4,264 to 4,381. Write those down, screenshot this, whatever you need to do. These are the levels JPMorgan's technical team is watching. Currently, gold is trading around $4,460 per ounce in international markets. Silver is at $77 per ounce. So gold is right in the middle of that consolidation zone they are describing, above the strong support, but below the major resistance. Now here's where the analysis gets really interesting. Despite the short-term technical correction, JPMorgan says the core logic supporting the gold bull market remains intact. What is that core logic? They call it the theme of currency debasement. Currency debasement is a fancy way of saying governments are printing money, running massive deficits, and gradually eroding the purchasing power of their currencies. This has been happening for decades, but it has accelerated dramatically in recent years. When currencies lose value, hard assets like gold tend to gain value. It is that simple. The report specifically points out that the US dollar index known as DXY continues to trade below the 100 mark. According to JPMorgan, this is a critical, long-term bearish signal for the dollar. As long as the dollar remains below this level, the market could easily be affected by the resumption of the downward trend that started in early 2025. Think about what that means. If the dollar continues to weaken, that is fuel for higher gold prices. The consolidation we are seeing now is happening against a backdrop that remains fundamentally bullish for precious metals. But that is not all. JPMorgan points to another signal that I find absolutely fascinating. The S&P 500 to gold ratio recently broke below a decade-long support level. When you divide the S&P 500 by the price of gold, you get a ratio that tells you how stocks are performing relative to hard money. A falling ratio means gold is outperforming stocks. A rising ratio means stocks are outperforming gold. According to JPMorgan, this breakdown shows striking similarities to market structures in the late 1970s. For those who know your financial history, the late 70s were the setup for the massive gold and silver bull market that peaked in 1980. Gold went from around $100 to over $800. Silver went from around $5 to nearly $50. Now, I'm not saying we are guaranteed to repeat that exact scenario. History does not repeat exactly, but it often rhymes. What I am saying is that one of the largest investment banks in the world is pointing to structural similarities between now and that period. That is worth paying attention to. The report concludes that the long-term trend of capital flowing into hard assets is far from over. The current decline is not a trend reversal, but rather what they call a halftime break to digest the rapid gains seen earlier. A halftime break. I love that analogy. The game is not over. The team is just resting before the second half begins. Let me ask you something. How many of you have been watching gold and silver for years, waiting for this moment? How many of you knew that eventually the monetary system would force people into hard assets? Drop a comment and tell me how long you have been following precious metals. I know some of you have been stacking for decades. I know others are brand new to this space. Both perspectives are valuable, and I want to hear from all of you. Now let us talk about copper, because this is where JPMorgan's analysis gets even more specific about what could happen next. The report makes a clear distinction between precious metals like gold and base metals like copper. While both categories are expected to consolidate, the drivers behind each are different, and this difference has major implications for timing. Gold is currently constrained by what JPMorgan calls crowded trades in the currency depreciation theme plus profit-taking after the parabolic rise. Too many people piled into gold at the same time for the same reason. When positioning gets that crowded, the market needs to shake out some of those positions before it can move higher. Copper, on the other hand, benefits from both the currency depreciation narrative and something else, something additional. JPMorgan calls it pro-cyclical rotation dynamics. What does that mean? It means copper prices are tied to the global manufacturing and industrial cycle. When factories are humming, when construction is booming, when the real economy is expanding, copper demand rises. This gives copper a dual tailwind that gold does not have. Copper benefits from currency debasement just like gold, but it also benefits from economic growth expectations. This is why JPMorgan believes copper and base metals will resume their upward trend earlier than precious metals when the consolidation phase ends. Let me say that again because it is important. JPMorgan predicts that copper will start its next leg higher before gold does. If you are trying to position for the second quarter, this is actionable intelligence. The recent deceleration in LME copper prices after touching above $14,000 per ton sparked concerns about whether copper has deviated from fundamentals. Through regression analysis, JPMorgan found that the current year-on-year increase in copper prices implies that the global manufacturing PMI should reach around 53. However, the actual PMI reading is only near 50.5. On the surface, this looks concerning. It looks like copper is overpriced relative to current manufacturing activity, but JPMorgan offers a different interpretation through cross-asset comparisons. They reference analog semiconductor stocks as a benchmark. These are companies that make chips for industrial applications, automotive, power management, and similar uses. These stocks are highly correlated with the manufacturing cycle and less influenced by the currency depreciation theme. Here's what they found. The price trend of analog semiconductor stocks also implies that the PMI will rise to around 52 by the end of the first quarter of 2026. since both semiconductors and copper are pricing in a stronger manufacturing cycle. It demonstrates that the logic of pro-cyclical rotation is deeply rooted across asset classes. In other words, copper is not irrationally exuberant. The market is collectively betting on a manufacturing recovery. Copper and semiconductors are both sending the same signal. This cross-market confirmation enhances the validity of the technical analysis. Jason Hunter specifically states that the current pullback in copper prices is more of a technical correction rather than a collapse of fundamental expectations. Now let me give you the specific levels for copper that JPMorgan is watching. Initial support is expected in the 12.74 to 12.15 range. This is where they see the first buying opportunity for short-term traders. If copper pulls back to this zone, JPMorgan considers it an ideal position for tactical trades. The more significant level is the $11,100 to $11,200 range. This represents a multi-year breakout zone. As long as prices remain above this level, the long-term bull market structure remains intact. If copper were to break below $11,100, that would be concerning, but as long as it holds above, the bull case survives. Currently, copper has shown a deceleration pattern after reaching what JPMorgan identifies as a medium-term target of $14,000 to $14,596, but it has not exhibited a sharp reversal signal like gold. The selling pressure is less intense and the technical structure is more constructive. So to summarize the strategy divergence that JPMorgan is highlighting, both gold and copper need to consolidate, but copper has additional support from pro-cyclical rotation. This means copper is likely to resume its upward trend earlier than gold in the second quarter. For astute traders, the key point of contention lies in differentiation. Do not treat all metals the same. They have different drivers and different timing. Now, I want to shift to silver because many of you are specifically interested in the white metal. Silver is mentioned in the JPMorgan report alongside gold as entering a consolidation phase. However, silver has some unique characteristics that make it particularly volatile and particularly interesting. Silver has dual nature. It is both a precious metal with monetary properties like gold and an industrial metal with manufacturing applications like copper. About 50% of silver demand comes from industrial uses including solar panels, electronics, electric vehicles, and now artificial intelligence infrastructure. The other 50% comes from investment demand and jewelry. This dual nature means silver often moves with gold during monetary crises, but also responds to industrial cycle dynamics like copper. In some ways, silver is the hybrid play between precious metals and base metals. Currently, silver is trading around $77 per ounce in international markets. After the extreme volatility we have seen in recent weeks, including that 38% crash from all-time highs followed by sharp recoveries, silver investors are understandably looking for guidance on what comes next. If JPMorgan's thesis is correct and we are entering a consolidation phase, silver should be expected to trade in a range rather than making directional moves. The key for silver investors is to identify support and resistance levels and to use staggered accumulation rather than trying to time the exact bottom. Given silver's correlation with both gold and copper, we might expect silver to find its footing somewhere between when copper bottoms and when gold bottoms. The industrial demand component gives silver some of that pro-cyclical support that copper enjoys. But the monetary demand component means silver will also respond to currency debasement themes alongside gold. For positioning purposes, this suggests silver could offer an interesting middle ground for investors who want exposure to both the monetary and industrial themes simultaneously. Let me pause here and address something important. I know many of you are asking whether this consolidation phase represents a buying opportunity. Should you be accumulating metals at these levels or should you wait for lower prices? Here is my honest perspective, and remember I am presenting both sides as I always do. The bullish case for buying during consolidation is straightforward. JPMorgan explicitly says this is a halftime break, not the end of the bull market. The currency debasement theme remains intact. The dollar remains weak below 100 on the DXY. The S&P to gold ratio has broken down in a way that resembles the late 1970s. If you believe the long-term trend is higher, then consolidation phases are opportunities to accumulate at better prices than you would get if you waited for breakouts to new highs. Additionally, JP Morgan has provided specific support levels that they consider attractive for buyers. Gold at 42.64 to 43.81, copper at 12.74 to 12.15. If prices reach these levels during consolidation, technical analysis suggests they represent value. The cautionary case is also worth considering. Consolidation phases can be frustrating and unpredictable. Prices chop around, stop out impatient traders, and test the conviction of even long-term holders. If you buy now and prices drop to the lower end of the consolidation range, you might be sitting on paper losses for weeks or months before the next leg higher begins. Furthermore, there is always the possibility that technical analysis is wrong. Support levels can break. Consolidation phases can turn into trend reversals if fundamental conditions change. While JP Morgan believes this is a pause rather than a top, no analyst has a crystal ball. The prudent approach, which I have discussed before and which most wealth managers recommend, is staggered accumulation. Rather than putting all your capital to work at once, spread your buying across multiple price levels and multiple time periods. This reduces timing risk and allows you to take advantage of volatility rather than being victimized by it. As one fund manager put it, quote, investors should avoid chasing prices or reacting to day-to-day moves. Metals work best as a supporting allocation in a portfolio, not as a core holding that you bet everything on. If someone wants exposure, staggered buying is a far more sensible approach than lump sum investing, especially in a volatile phase like this. End quote. I think that is wise advice regardless of whether you are bullish, bearish, or somewhere in between. Now let me also mention what JP Morgan says about oil because it is related to the broader commodities picture. Brent crude oil is expected to maintain range-bound fluctuations. According to the report, the rally driven by geopolitical factors has encountered resistance in the upper $60 range. A sustained breakout above $70 is considered unlikely in the near term. However, there is a flaw under oil prices. The dense moving averages in the 61.75 to 62.18 range are expected to provide solid support. Why does oil matter for precious metals investors? Because oil prices influence inflation expectations, which influence monetary policy, which influences the dollar, which influences gold. Everything is connected. When oil is stable or range-bound, it removes one variable from the equation. The metals market can focus on its own dynamics without oil-driven inflation spikes or collapses muddying the picture. Let me also address the geopolitical backdrop because it remains relevant even during consolidation phases. Global tensions continue to simmer. Trade disputes between major economies have not been fully resolved. Central banks around the world continue to accumulate gold at a record pace. The dollarization trend, while slow, continues to progress as countries seek alternatives to dollar-denominated trade and reserves. These factors support the long-term bull case for precious metals. Even if short-term price action is choppy, consolidation phases do not erase fundamental drivers. They simply provide opportunities for patient investors to position before the next move. One thing I want to emphasize strongly during consolidation phases: the worst thing you can do is make emotional decisions based on short-term price swings. If you have conviction in your thesis, consolidation is not a reason to panic. If you do not have conviction, consolidation is not a reason to FOMO in or panic out. Have a plan. Know your levels. Understand your time frame. Are you trading on hourly charts or investing on yearly thesis? The answer to that question determines how you should react to everything I am sharing. For traders with short time horizons, consolidation offers opportunities to buy support and sell resistance. The chop can be profitable if you manage risk properly and do not overstay positions. For investors with long time horizons, consolidation is just noise. The long-term trend is what matters, and according to JP Morgan, that trend remains up. Use the consolidation to accumulate at favorable levels and ignore the day-to-day volatility. Now let me give you my key takeaways from this entire JP Morgan report. Takeaway number 1, all major metals, including gold, silver, and copper, are entering a consolidation phase. According to JP Morgan's technical analysis, this phase could last weeks or even months. Expect volatility within a range rather than clean directional moves. Takeaway number 2, This consolidation is a halftime break, not the end of the bull market. The currency debasement theme remains intact. The dollar remains weak below the critical 100 level on the DXY. The S&P to gold ratio has broken down in a way that resembles the late 1970s. Long-term trend remains up. Takeaway number 3, copper is expected to resume its upward trend earlier than gold due to pro-cyclical rotation dynamics. If you are looking for the next leg higher, copper might lead the way in the second quarter. This is JPMorgan's explicit prediction based on fundamental and technical factors. Takeaway number 4, specific levels matter. For gold, resistance at 5,100 to 5,150. Support at 4,500 and strong buying zone at 4,264 to 4,381. For copper, initial support at 12,74 to 12,1005 and critical support at 11,100 to 11,200. Takeaway number 5, patience and discipline are essential during consolidation phases. Staggered accumulation is preferred over lump sum buying. Position sizing matters. Do not over-lever. Do not make emotional decisions based on short-term volatility. The metal rally is taking a pause, but according to Wall Street's top investment bank, the music has not stopped. How you position during this halftime break could determine your returns when the second half begins. Stay sharp, watch the data, watch those levels, and I will see you in the next video.